Okay, this is being recorded. Again, one of the things that I say at the beginning of all these, it sounds like a broken record to some of my regulars, but watch this again if you aren't accustomed to this strategy or some of the nuances that I particularly teach around this strategy, and especially if you aren't accustomed to options, because it'll make it sink in if you watch it relatively soon right afterwards. If you wait too far down the road, a couple of weeks, months, whatever, it's going to be like learning it all over again. And this is going to be on how to create a synthetic short position for bear markets. Now, when you hear about hedge funds and stuff like that using short stock positions to take advantage of downside, it actually acts the same way as a short position, but you don't have to borrow the stock. You don't have to pay maintenance for that, and you don't also have to pay the dividends with the synthetic short stock position. So that is a nice perk to it, and I'll talk about some other perks along the way. But let me get a couple of things out of the way before we get started here. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Been trading for over 25 years now, and I started out trading in college with a psychology degree with some money I had earned, in middle school, high school, and started playing around with it, got into options, switched my major over to finance, and after graduating I moved to Chicago Board of Trade and started trading on the floor. I actually started out as a runner, those guys that are running around the floor, moved up into the pits, bought my badge, and started trading there as well. So in my time through college, the Board of Trade, and even now, I've traded everything from stocks, financial futures, commodities, options, on all of these markets in all market conditions. Got to get this disclaimer out of the way real quick. Any opinions, news, research, and analysis or other information contained here or material provided by Pro Trader Strategies or associated companies is general commentary and does not constitute investment advice or solicitation to buy or sell any of the futures, stocks, or strategies. At the end of the day, we are an educational firm, and we're here to teach you guys how to swim, not to swim for you. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. One reason why I can't give you guys advice is because I don't know what's in your portfolio and I don't know your risk parameters. So it would not be right for me to tell you this particular stock you have to put in your portfolio or use this strategy today. That's not ever going to be heard by me. You need to take what I am doing or what I'm teaching and implement it in your portfolio in your own way in regards to your own risk parameters and portfolio. You can follow me on Twitter at Wolfman's blog. If you guys have been following me, you see that I put out all my earnings trades, or at least most of them. Sometimes I do forget. Excuse me. and other economic stuff that I see along the way are different market situations. I'll throw that stuff out there too. And you can also follow us at Pro Trader Strat, and that's the parent company. They give all kinds of little investment quips and also deals on different things that we have going on. Specifically, there's a lot of hassle that goes into shorting stock, and a lot of people don't do it because of the hassle, and they think that it's counterintuitive to what you should be doing, but there's a lot of good things that can come from, especially synthetically shorting stock using options, you guys. If you're a buy, if you have a lot of stocks that you're long, or you have a tendency to have long deltas, which means you're long basically the underlying, the way to hedge some of that risk to the downside is to start looking for opportunities to synthetically short these stocks. It is going to give you a lot more bang for your buck than just a long put spread, or even a long put for that matter, because you're going to have a lot more short deltas, which will help you in the long run really equal out or balance out your portfolio, to make it not necessarily delta neutral, but at least more negative deltas added in there to take advantage of different underlyings. It's great for when stocks are overbought. You know, a lot of people are saying, you know, the stocks in general are overbought, but you know, the economic data coming out has been relatively mediocre, so there's a lot of validity to that. I have been looking at the charts and starting to look like the stocks are going to try and press for more all-time highs, and but there's still opportunities in there, the retail sector, things of that nature. You're going to always see different areas or different stocks that are weakening, or maybe even in a downtrend, which, you know, might bring up that bearish assumption in that underlying. If you see it's in a downtrend, maybe a bear flags, things of that nature when you're charting, this would be a good opportunity for a synthetic short. Also, like I mentioned with the bear markets, if there was a bear market trend, or even the overall equity bear market, we haven't seen that in quite some time, but there are opportunities, like I mentioned, in different stocks that are in bear markets. And you can use this as a pairs trade as well. You know, we talked about the synthetic long stocks last week. You know, there's always opportunities to hedge a long by using a pairs trade. If you wanted to, if you weren't really sure, you could look at a couple of different stocks in the same sector and kind of pairs trade those away. And overall hedging, which I mentioned, for that portfolio when you're starting to get exceedingly long, especially at like all-time highs, rather than to cover some of these stocks, maybe you just start adding in a pairs trade here and there. You've made a lot of gains in a particular sector. Maybe you start hedging with some synthetic short stock positions. And I mentioned this as well, the portfolio adjustment. Sorry guys, I got a little ahead of myself with all my talking in the beginning and covered a lot of my great talking points, I guess. But like I said, a delta adjustment for the portfolio. Trevor's asking, overbought based on what? We'll look on that. You know, basically, you know, if a stock's been running forever, there's obviously a situation where it starts to flag out, where you can start seeing it top off, and that's usually an indication of an overbought position on a particular underlying. And there's all kinds of different other metrics when you start looking at the valuation of those stocks. You know, one could say that Tesla is overbought because you know, they sell 10,000 cars a month in relationship to maybe Ford and GM, who are selling millions of cars a month. And you're looking at Tesla's valuation, it's worth more than Ford and GM. So it has a higher valuation than both of those two, not combined, but both of those two. And that might be an indication of an overbought position in my eyes. But the trend is my friend with Tesla. It's like trying to fade Google and Amazon too right now. So then on to same risk as the short stock position. I mentioned this, and the reason why it's the same risk is because it's going to be risk one to make one, in a sense. For every dollar down move in this underlying, we're going to be able to gain a dollar, just like if you were short, or inversely related to if you were long a stock. So a lot of times when you're doing a put spread, you're only going to be gaining maybe 50 cents for every dollar down move. This is a more aggressive short position than a long put spread, or even a long put for that matter. Very difficult unless you're buying way deep in the money puts to get the same risk parameter as the short stock position. And that way deep in the money put may only still be at like a 90 delta or 93 delta. So it's for every dollar move down in the underlying, you're only gaining 93 cents. Whereas when we set this up, we are going to be able to get dollar for dollar in the beginning anyway. Once it goes really deep, it's going to lose a few deltas the more the longer we are correct, but in the beginning it is going to act like a synthetic short stock, 1-for-1. And we're going to be using 50% less buying power than a short stock position. In that, when you're selling short stock, you usually have to come up with 50% margin for whatever that underlying is. So if you were doing 100 shorts in $100 stock, you would have to come up with $5,000. This year, you're going to have to come up with about $2,500 in that sense. And somebody actually last week had some really good rates. I don't know if you get the same kind of rates with this, but you're also not going to have to pay these maintenance fees or the cost to carry with the short stock position, and you don't have to pay the earnings. So when you're short a stock, you actually have to pay those earnings out for that particular underlying. So that makes that a little bit better as well. You don't have to worry about that. That's what I was talking about, those hassles with synthetically shorting. And when you're using less buying power, that intuitively increases your return on capital. Anytime you pay less or have to lay out less money for the same exact risk parameter or the same exact dollar for dollar move, then you've increased your return on capital. And how do we set up? Well, it's selling an at-the-money call and then buying that same strike at-the-money put. Now, we're going to try and build this so where it's 100 deltas, and that means that for every dollar down move, you gain $1. That's what the 100 deltas means. There's also another way to do this, especially if you're newer to this strategy, we talked about this last week as well. It's more like a risk reversal, but you could be selling an out-of-the-money call and then buying a slightly out-of-the-money put, and in that you would reduce your delta, say, to like 50, and that would make it like you were only short 50 of the underlying position. So whatever the amount of deltas adds up to be, that's how many synthetic short stocks you own. Does that make sense to everybody? If I'm synthetically short this position with 100 deltas, that means I'm short synthetically 100 of the underlying. If I'm synthetically short only 50 deltas, that means I am synthetically short only 50 of that underlying. All right, keys to success with this, especially when we are correct and even when we're wrong, is picking the right underlying. Because if this stock does make that move that we want, and eventually one of our options is going to go deep in the money, those deep in the money options start getting a little wider and less participation. And have less open interest. So we want to be in this stock that has a lot of in a stock that has a lot of participation in the options. So that is the key important takeaway for picking the right underlying. It makes sure there is a lot of open interest going in there. And one of the things that I talk about with picking the right underlying, you can tell in the option montage, any stock that's under $100, we want our bid ask to be less than 10 cents. If it's over $100 stock, my rule of thumb is basically take the decimal point and move it 3 ticks to the left of what the underlying is trading. And that's how wide the bid ask should be in the option montage. For example, if it's a $300 stock or say a $500 stock, if I move the decimal 3 ticks to the left on that $500 stock, it's 50 cents. So the bid ask should be at least inside 50 cents, give or take maybe a couple of pennies. And picking the right strike. I mentioned this with the deltas. That's how we're going to determine how many deltas we want to have. That is going to be key to success on this. And if you're very new to this strategy, picking those right strikes, maybe you do want to start out with a more of a less delta setup. Is this IRA safe? It is IRA safe, but it may not necessarily meet the parameters of what the IRA says. When you're short naked calls, which you aren't really short a naked call, but in a sense they're going to kind of look at it in this situation. Then what we're going to do is, and remind me of this when we're going through the montage, you just want to buy a far out of the money call for like a nickel, and that makes it IRA appropriate, believe it or not, because then you've created defined risk. We aren't going to, I would hope that you would never take that risk to the defined part of your long, or your long call, but you know, putting it in there meets the rules of the IRA in that you can't be short a call. So naked short a call. So if you just buy, we're going to be selling this call and getting about $1 or something like that. We're going to be paying almost very close to what the actual value of the underlying is with this strategy, or sometimes we'll get a credit, but it's going to be right around where the underlying is trading. And you buy that out of the money call for a nickel. That meets the requirements for an IRA. But please don't ever take this strategy that far to where you're being tested on your long call if you do that in an IRA. All right, so picking the right duration. I want to get out. I want to be out pretty far, even probably further than this chart goes. And the reason why is because I want to have a lot of room, a lot of time to be right. And the further out you go, you end up getting a little bit better pricing. We might not necessarily plan on being in it for 120 days, but our pricing basically makes it very beneficial to go further out than less time, and less time you have a time constraint on being right. You have to be right immediately, whereas further out you go, if the market just trending sideways, you can stay in this a little bit longer. The other aspect of that, being out further, sorry, my thought just slipped me on the other aspect, but oh, with the theta decay, we don't really have to worry necessarily about this theta decay because we're selling an option and buying another option where those extrinsic values are going to relatively offset. So, and we'll show you how that works out. So we don't have to worry about theta decay. Even if you were doing it in here, it's more, we want a longer duration to be right, and the further out you go, you get a little bit better pricing on some of those. And that's another reason to pick the right underlying, where there's a lot of participation in there, because some stocks may have a lot of participation in the near term expiry, but further out there might not be that much participation at all. So we want something that has a good tight bid ask, even, you know, way down the road. Picking the right environment. Now with this one, because our premiums are going to be offsetting, I look at picking the right environment as we definitely want to have a the market ready to roll over and sell off. So we need to have things set up where it's maybe your technical analysis, like I said, maybe it's a head and shoulders and it's breaking through the neckline, things of that nature. There's all kinds of things we can look at to determine when a stock is ready to sell off. So that, Trevor, goes back to your overbought basis. You know, you can start seeing overbought positions when we start seeing maybe the head and shoulders or a bear flag, or, you know, a pennant. There's all kinds of different charting setups. Maybe it's even bumping up a Fibonacci level and things of that nature. When you guys see my platform, you're going to see that I look at market portfolio. So a lot of times when the market comes back down into my area of breaking through like a value area high, that might be the indication where I'm going to be looking to sell that strategy or sell that underlying with this strategy. And knowing your exit strategy before entering the trade, the only thing I can really say with this is you have to really do some soul searching on what your risk parameters are. How much risk are you willing to take on this? So maybe you're looking at it like, you know, I'm willing to risk $1 to make $5 or risk $2 to make $10, things of that nature. You definitely don't want to risk more in this strategy than you are able to make. So make sure you stick with that and write it down. When you're entering it, you had a reason why you were entering this synthetic short on this stock. Maybe there was a shooting star or something like that, and it got confirmed, let's say, with the next day's strategy, and you're like, okay, this is set up for a nice sell-off. You enter this strategy. Well, where is your out, generally speaking? Where would you put your stop if you were trading, you know, a future or anything else? And that, put it down on paper and stick to it. Don't go to your piece of paper and scratch it out and write a new number after it starts going bad. Just get out, retool and die, look for something else. Another thing, if you don't write it down, you will have a tendency in your mind to let it play with these probabilities, and you'll be thinking, you know, well, I kind of broke through that first area, but I think it's going to come back. No, stick to your guns. Write down your strategy for exit immediately. At this point, I'm getting out, and do the same really when it's a winner. You know, pick your out for the exit, pick your out for your profit, and kind of stick to that because you will do much better in the long run. So Mercy is saying, it's my first time to attend your webinar. Would you show us some samples? Absolutely. And I usually bore everybody, I'm sorry, with these slides, but then I go into the live trade. Well, it's not live, it's after the close, but I pull up my trading platform and we'll go through and build it out. And as a matter of fact, I give you guys the opportunity to throw out a couple of stocks that you think might be prime for a short position. So you can think about those two while we're going through all of this. And we're almost through all these, believe it or not. So risk profile, max profit is achieved when and if the underlying goes to zero. I'm not going to ride this thing into the dirt, so I'm just going to play it to where I think it's going to go to. And I'll show you some of that, the things that I look at for that. But that, you know, is your max profit. But hopefully you don't think you're going to ride this thing into the dirt. And the other thing is your max loss is infinite, just because the fact of the matter is, as a stock, you know, could do something like Google. You know, you shorted at 300 and now it's at 900. Well, that is seriously going to feel like it's already infinite if you've done this. And I pray that nobody ever rides anything this long or that long against you. That just is not very good financial savviness, I guess, for lack of a better. Break even. Now, our break even is going to be our strike price that, you know, at the money strike plus the credit. If we add the credit in, then that would be our break even, or if you did it as a debit minus the debit. So, and we will go through all of that stuff here very shortly. So, will we get a recording of the webinar? Absolutely, Randolph. And one thing I always say at the beginning of these is watch this again. Even if you've watched this all the way through, Mercy, same thing, especially if you're new to option strategies, go through it again and watch it as soon as you can, you know, whether it's a day or so, because it'll make it sink in. Some of these nuances will fly by you. Maybe you're thinking of a question or things of that nature, and you might have missed something. When you go through and watch it again, it will kind of solidify it in your long-term memory. This first time through, it's going to go to your short-term memory, and that stuff gets lost. If you watch it a month down the road, it will be well good or well gone by that point, and it'd be like learning it all over. All right, so let's get up this platform and start playing around. All right, so here's the platform. So this is usually when I start talking about, throw out some stocks that you guys have been looking at. You like in your mind. I think this is possibly a opportunity to short something. So, because believe me, I go through a lot of stocks every single day and look at stuff, but I can guarantee you there is stuff that I may have missed. Oh, Daryl's going with Facebook right off the bat. It's another one of those that's kind of a, blasting off, but sooner or later they do kind of have to start seeing some chinks in their armor. Now, depending on their setup, we could look at stuff with like the Fibonacci. Oh, that's going to give me my trend line. So I'm going to just pull up a Fibonacci just to see where the, it doesn't really matter because I'm not going to go look at it that far out. So I'm just doing that as a quick and dirty, just to kind of get a look at it. That's not really helping me out a whole lot with this one, but let me just see, remove that drawing. No, I just want to move this one. Remove drawing. All right, so usually, so what I like to also do when I was talking about one of my things is when the market comes down and comes back into this value area, it's going to want to come down here to the point of control. So that's a nice little setup. The other thing I also look at is when the 50-day crosses over the 200-day. Those are other times that I really like to do it. We'll go through Facebook because I know that they have good tight markets, generally speaking. This is what I was talking about. 7 cents wide, it's a $150 stock for all intents and purposes. So that is a nice tight market. But you can see as the market gets deeper in the money, these bid-asks are staying pretty tight. I mean, 50 cents on a 98 delta is pretty tight. And this is what I was talking about. If you would have to buy a deep in the money put to get the same bang for your buck as this, or sorry, that's the calls. You'd have to even buy it further in the money put. You're only going to get 80, it's probably 90, closer to 90. I think these are getting thrown off by the wide bid ask, but you can see if I were to buy this put, the 200 put, I'm only going to get 90 cents for every dollar down move in this underlying. Whereas when I set it up with Facebook, I'm going to go out a little bit further. Usually, I like to go out 100, maybe 200 days. We'll check out both of them. So we look at the deltas. So what we're doing here is adding up these deltas. Now this is a positive delta because the assumption is you buy a call, you have long deltas. Or if you buy a put, you have negative deltas. Well, what we're doing is we're selling a call. So that's going to give us negative deltas. So, and then we're buying these, so we're getting negative deltas there. So 59 and 41, that gives us 100 deltas. That's what I'm talking about, creating that scenario where you are going to build 100 deltas. This one's a 50 delta. This is a 51 delta. So in that sense, when we added these two up, that's going to make it 101 deltas, which would give us synthetically 101 of the underlying. The other thing I was talking about is when you want to build it out, kind of get close to maybe 50 of short Facebook, then you would be buying these 135 puts because it's 23 deltas, and then you'd look for something to counter that. Maybe you would do the 160 calls and you'd have 53 deltas on, give or take. So you can kind of play around with those to get, make it match up to how many short of this underlying you want to implement. But in this, so let's go, oh, these just switched to 49, so that's perfect. So let's look at these 150s. So I said we were going to be selling these, so we're going to be selling them at 720, and then we are going to be buying the 150 puts here. So that gives us short around 100 deltas. Now we got to figure out where our break even is, right? So I said with the the puts, we're going to be subtracting from the 150. So 150 minus 123, that puts us at 148.77, right? So 148, we're short these at 148.77. So that's the benefit of going further out in time also. That gets our break even above where the underlying's trading. So it gives us a little wiggle room to the upside. I kind of always like setting it up to where the break even is above me here because that if the market goes up a little bit, it still hasn't touched my break even necessarily. Options, yeah, Snap. Somebody's asking about Snap. We can look. I don't know if they are, and we could look at it though. Yeah, Snap would be a good one because, I mean, they even claim themselves, we have never made money in the past, we aren't making money now, and we don't foresee making money in the future. That's a great business plan, said no one. Well, said Snap, I guess. Anyway, so that's how we would kind of set that up. And then that we don't want to do this with 1,000 lot. So try and build that out. So, that would be the 100 of the underlying because we did or 101 because our deltas are slightly out of line there. But that puts that way. And if you wanted to make it exactly 100 deltas, you could even do the same thing here and hit the sell on these 145s. Just to give an example as to setting this up for 100 deltas, and now we have a credit. So what we have to do with that credit, have to add it in here to figure out our break even. So 145 plus 367 gives us 148.67. Again, it's still above where the underlying is trading. That's a nice benefit there. All right, so let's look at another one. Somebody else was asking about WBA, Walgreens. So let's look at the chart. Walgreens definitely looks pretty bearish. They just had their earnings, so I'm guessing they probably don't have earnings coming up anytime soon. That's another thing with this, you guys, is I don't like to do it going into earnings for sure. What was it, Walgreens? So, in that, I'd want to be out before this earnings. So, you can still go out there that long duration, but make sure you're out by the next earnings, I would say, with this one. Also, so let's go to, I know Walgreens, it generally has pretty good markets. So what's the further out one? So let's close those out. Let's go to the 154s. 154 days to expiration. Look at our deltas, try and get that to where we're at about 100 deltas. Either one of these will work. Got the 182, so let's sell those. Buy these, that gives us 100 deltas, 44 plus 56, or negative 44 because we're selling those, right? And plus a negative 56 gives us negative 100 deltas, which is what we are looking for. And I bought the puts. I need to get it to sell the calls. I don't know if you guys have ever done this before, but if you haven't and you are actually using Thinkorswim, the way to build this stuff out when I'm hitting this, I am buying the puts and then I hold down the control key and then hit the sell button. That's how it adds it in. Otherwise, it's just going to click one or the other all day long. And if you guys watch many of my videos, I never play around with this really. I always go to the single and build out all my strategies. So we have 100 deltas. Next thing to do, figure out where our break even is. So we're going to be subtracting 176 from 82.5. Of course, I did it with the hard one, so I'm going to have to go. That's going to put us at around. Somebody else can probably do that. It's going to be around 80.74. Is that right? That's in my head kind of math. So it is still slightly above where we are. Can I do that, or is that 81? It's probably 81.25 actually. I did the math completely bad. Let's just pull up the calculator just to make sure we get it right. 82.5 minus, I'm sure somebody else is 80.24. Is that right? 76, 80, 74. Yeah, so that's what I said, right, originally. So that puts us about just slightly above there, which is fine. You know, our break even's still above us. Walgreens looks pretty bearish, but you know your exit strategy. That would be one of those things. Write it down where you think you're going to get out on it. For instance, with me, I would probably say I would pull up a Fibonacci on this just to kind of get my retracement area. I'm going to, like, again, do it real quick and dirty. So, you know, I would definitely look for it to break. For me, I would wait for it to get through here, and then I'd probably look to get out somewhere in here. You know, just a quick down move on it. I wanted to get through this Fibonacci probably before I'd put that on, and then I'd write down $78.50 or something. Okay. All right, so somebody else was asking about Snap. Let's look at Snap. What happened there? Snap. One key thing with Snap, if you are involved with Snap, the IPO price for the people that, you know, got in early before they actually opened the market to the public was $17. So that's why this market really got defended here quite robustly, is those people that got in early were really in there trying to defend that area. This is where it opened on the first day, but keep in mind, Snap, $17 is where the insiders, in a sense, kind of got in, where they IPO'd it. And let's see if they have any options in here, if they're any good. So they're a quarter wide, they're 45 cents wide. This is what I was talking about, tight bid ask inside of, you know, they should be like at least a nickel for a $20 stock. So that's, I wouldn't even trade the options in here with Snap. I mean, these are 10 cents wide here, but that's what I was talking about with the deep, the further out you go. When these are going to be 10 cents wide, you know, these are going to get even wider. We can also look at the volume and open interest of these. They do have pretty good volume though, which is surprising. These not really leaps, but long-term options are that wide. So I'm just going to skip that one because I don't play in these when they're that wide. The reason why is because you got to give up so much edge to get in. You know, you got to give up 10, 20 cents to get in, and then you got to give up 10, 20 cents to get out. You know, that's 40 cents in and out. That really eats into your overall return at the end of the day whenever you have to do that. When you're only having to give up a penny to get in, get out, you know, and that's definitely a lot better. And hopefully when we're right and this market goes down, our options, you know, deep in the money are going to get really wide, you know, so we don't want to be dealing with that, having to give up that much edge. That makes sense? All right, so another one was, let's see, AXP, oops. So I was looking at these actually, I was looking at Visa and MasterCard also earlier because, you know, they were starting to look pretty weak as well as the rest of the financials. But the reason why I like this, it is in a downtrend, and this is what I was talking about. It's in a downtrend. It came down inside of my value area. So the target on this, once it settles in here, is it really wants to migrate towards this. The reason being is this is where the most time and value has, or the most time and volume has been traded in American Express. Now, what does that mean? That means the market finds value. This is where the market is comfortable trading this. Now, of course, the value area can move up, and we've seen a lot of volume and open interest created up here. But at the end of the day, you know, all these shorts wanted to come back, and it just always has a tendency to come to this magnet. It's where the market is very comfortable and where the most amount of shares have been exchanged. So I would look for American Express to kind of start looking to show some weakness, and it's going to probably find a little bit of support on the 200-day, but this gap here would really accelerate because there's just no interest at all at trading around these prices. So, and again, you know, try and be out before the earnings come around again. I think I saw a quick question. What delta do you recommend? I usually, when I'm doing this one, I usually go with the try and build it out so I get as close to 100 deltas as I can. And the reason why is, you know, like I said, if this market goes down and, you know, so the calls are going to go further out of the money, you know, if we look at this, say for instance, it went down by, you know, $10 or $15, and I'm only saying that because, you know, if the market goes down, that's what's going to happen to these deltas going up, right? So we have a 9 delta here on these 90s. If we look at the deltas over here, you actually didn't lose that many, which is a little strange. We go even further, 96 and 3, so you're starting to lose those. The deeper in the money, you usually end up losing at least a couple of deltas here and there. So it's not really happening. You could look at the 85s. That those are, you lost 1 delta. 80 here, you lost 2 deltas. So, right? 88 and 90, no, not really. So usually, generally speaking, you will, believe me, start to lose a few deltas. You know, it's 1 or 2, maybe 5 at the most, but you will start losing deltas. So just keep that in mind. And I don't usually do a delta adjustment to get back to that. I just kind of let it go. I don't care about the 1 or 2 cents going forward. Did that answer your question, TJ? What formation is best for this strategy, trending market or channel? Great question. You know, it's really whatever you're comfortable with. You know, everybody uses different technical analysis. Some people use Bollinger Bands, things like that. I would just implement it around your favorite strategy to go long or short, whether you're using Fibonacci or everything else. It's hard for me to say. I usually use, you know, my favorite one is the market profile. So that's why this American Express kind of is interesting to me. So let's look at, so we want to sell this one, and these are pretty wide too, so they're 20 cents wide. Usually American Express has pretty tight markets. See, 2 cents here. So I'm going to assume people are in the weeds, as we used to call it, on the floor, and that I won't have to give up that much edge because there's going to be a lot of people in the weeds, meaning they're watching it and they're just not participating right now. And then buy that one. So buy that one and sell this one. That gives us very close to our 100 deltas, 99. So and we have the debit, so our break even is going to be trading right around what is that, 76 86.85? No, wait, 76. Sorry, I'm having trouble with my subtraction today. So it's 85 off that, so it's 76 76.65. So 76.65 is actually our break even is going to be below us. So we got a little work to do. Chris asking, Eric, do you have your own service of a part of the pro trader strategies with others? Does this mean we get not only you but others too when we sign up? There are some packages where it is combined with other ones, and we're not offering that one today, but you can call us at 310-598-6677. Do I provide mentoring as well as part of your service, just like you're doing now? Absolutely, Chris, I do. I have a no inbox policy for my premium members, and that means you reach out to me with anything, and I will help you out with it. So, and I will get back to you immediately, if not sooner, because I know how it is. When you're trading, you got a question, you want quick answers. So my email is always open. So as soon as I get it, I try and reply as fast as I can. And TJ's asking, you're using TOS? Yes, I am. What are the letters next to the price? ZH. If you're talking about, you're not talking about, oh, on here, these are the different exchanges next to the, that's the exchange that it's going to. And, you know, you can go in here and I think you can pick your exchange too. So this right here, this is the exchange. I always have it as best. So you could do the Philly, the CBOE. If I just wanted to do the CBOE, it would just send mine to the CBOE. But I do it for the best market. So it might, one of my options might go to the CBOE and the other might go to the Philly exchange, whoever's got the best market. That makes sense? How do you bring up market profile on TOS? SP, I don't really have enough time to go through that, but I actually have a whole couple of classes on how, or webinars on building up. They're not full-on webinars like an hour long, but show you how to go in here and pull it all up in the charts. Like you go through the gears and set it all up. So I show how to do that. I even show how to set it up on a daily chart if you're like an intraday chartist and you like it, where you want to play intraday. And I talk about how to trade that as well. But you can do that. You can sign up for that too. Hello, Eric. Thanks for your excellent instruction. Very grateful to you. Thank you, Chris. Appreciate that. I think I saw another question up there somewhere. Okay, I think that's it. So if the market is going down, how would you place your order? Buy a put and sell a call. Absolutely, Mercy. So what I would do is, you know, it doesn't really matter to me which one you do first, but I usually try and look at these two and find the 100 deltas, like I talked about, 59 and the 41, let's say here. So therefore, I would sell this call and then hold down control for this one and buy that one. That gives me 100 short deltas. Now, I wouldn't do it as a 10 lot. I do it as a 1 lot. So in that, you know, now we have to add this credit in to the 75. That gives us $1.68 credit, makes our break even 76.68, which is still slightly below where this underlying is trading. Trade requires 2 commissions, or can you trade the call and the put as a unit? Well, it is going to be it's going to be 1 commission based on a 2 lot. That makes sense. How do you protect your portfolio? Well, this, if you're overall long, this is going to help you protect your portfolio on the downside. I have other ways that I talk about protecting portfolio, especially if, you know, you have bonds in there right now. If interest rates go up, those bond values are going to go down and it's going to hurt your portfolio. So I talk about that in different webinars as well, which I don't have time to go into, but that's all part of the premium membership that you guys can take advantage of. Market that is going up, would you do the same thing, buy a put and sell a call, or vice versa? Vice versa, Mercies. And I know you said earlier on that you're new to this class. Last week I did it on synthetic long stocks. So you know, in that regard, you know, you get a lot more bang for your buck, because if you're used to going out and buying stock, say you're going to go out and buy 100 shares of American Express, that would be, you know, $7,680 for 100 of the stock. Plus, you're probably paying a lot more for your commissions. Whereas if you did this as a synthetic long in American Express, it's going to be a quarter of that. So you're going to be paying, you know, less than $2,000 for this strategy. Or your margin is going to be less than $2,000 to do the same thing. So that's the benefit. You know, obviously you're not going to get dividends, and you're not going to you know, be able to keep it longer than 100 and some odd days unless you went out further and then, you know, did it like 600, you know, and 9 days. But then, you know, you'd be looking at holding that for a very long time. On the synthetic longs, maybe you normally do that, and then that would be an opportunity for you. But at the end of the day, I usually teach this for traders who aren't really used to holding things for long durations like investors are. Yeah, I got a promo that I'm going to be talking about here in a little bit. Also, so a couple of them that you know, what I was talking about before, where we got kind of a little bit late. There was a couple of them that I pulled up off of Steve Primo's new chart platform. It's called the PTS Primo Charts. It's Pro Trader Strategy Primo Charts, and you can also get some of my options stuff off of that, which I think Chris was talking about for combinations, so that would possibly be something that you could talk to our guys about. But one of his was coming up with CVS, which looks kind of interesting. It's not one that would have hit my radar because I usually don't trade right around this point of control for the most part, because that's, you can see once markets kind of get around the point of control, they just kind of bounce in and out of it. But after looking at it, it's gapped down, and it actually has what's looking like a confirmation to the downside here. So usually when they kind of start getting overdone, they're going to go and test this value area low. So that might be an opportunity that I'm going to have to look at for that, just for the because that platform was giving a sell indication on one of the strategies. So I'm going to be looking at implementing this on Monday. So keep your eye out for it on the daily market commentary. So we want to sell that one. We're not going to get quite 100 deltas, and then we're going to buy this put here. We get a credit for it, 75. So our break even is at 76. Oh, I did it in the 28. Sorry, I don't want to do that. I'm going to go out about 180 days. So, and see, this is what I was talking about with this one. Look how the markets are still pretty tight. It's inside of my rule of 10 cents wide for a stock that's under $100. So we got 7 cents wide here. So I want to sell that one and then buy this put here. So we're looking at our break even at 85.90. Or sorry, 75.90, which is above, or it's just below actually where we're trading right now. So that one's a little bit lower. So I might look at this one to try and build it out to get that a little bit better. Usually it's going to be about the same, 75, yeah, or sorry, 75.97, so 76. So it's still, our break even's a little bit below us. It's not a make or break for this, but I just really would like to have it above where we are. But we've got our 100 deltas on this, and I would say to myself on this then, know my exit strategy. If it got basically above this area right here, 70, 77, 74, whatever the high of this is, 77.63, if it got above that candle, I'd probably be looking to get out of this. And my target to get out would be right here at 72.30 or 73 maybe even. That makes sense? So that's how I would usually look at this, to figure out where my out is. I know I don't usually play around with stops or anything like that. I do play around with alerts to give me an alert when a stock would trade above that level, and then I'd get out. Make sense? No, you do not have to wait for the option. I never wait for the options to expire, Mercy. When you start watching some of my videos, you'll see I don't like to write anything out very long at all. So I never like to take anything into the expiration. I play my probabilities and I try and get out early. Would it still be selling if I'm selling a credit spread instead of selling a call? What would it still be selling if I sell a credit spread? Yeah, so I think what you're asking in a sense, you know, I have different rules for selling a credit spread, but great point, and thank you for reminding me of this. If I were to do this strategy out here and wanted to make this IRA appropriate, I'd come out here and try and buy the one that I first buy for a nickel or less, which is a 1 delta. So that would make this IRA appropriate, because I'm now no longer naked short that call, because I've defined my risk. But I would never, ever be in this trade from 75 to 105, $30. There's just no way. So makes it appropriate for an IRA, but it does not make it appropriate for us to take that kind of risk. That makes sense? Do you ever use the look back feature? I don't usually do the look back feature. Somebody else says alerts on toss. Yeah, you can set up alerts on toss. Do you have any opinion on PLCE? I don't recognize that off Children's Place. Yeah, I was going to say I don't recognize this stock. I don't think I've ever traded it, but I don't have any recommendation on it. This is why I haven't ever traded it. They're $1 wide at the money, 60 cents wide for a $100 stock. My rule would be probably, you know, maybe 11 cents, because it's $100, just over $100 stock. Move the decimal from here 3 ticks to the left, and the bid ask should be inside of 10 cents or 10.5 cents in a sense. Roll it up 11 cents would be my limit on that. Let's see if these are any tighter. So that's 30 cents. See, it's still outside of my 25 cents. I wouldn't be playing. Does that make sense? How do you find appropriate stocks to trade? That's how I do it. I mean, I almost never trade the outright underlying, but that's how I do it. I go to the option montage, and when I find one that meets the rules, I mean, there's stocks over here I've never even traded or hadn't traded before I found them, you know, but you know, when I see stuff out there, maybe on Twitter, or I do a scan for something, like on Steve Primo's new chart platform, I did a scan on it, which is really easy, and it actually gave me a couple of Exelon was one of them. I mean, I'd never traded Exelon. It actually was another indicator of a short opportunity. And I started looking at it. I was like, oh, it's a $35 stock. It actually meets my rules on some of these. So, I mean, that it is, you know, for all intents and purposes, this is a Friday at the evening, but it was meeting the rules on being at least around 10 cents wide for some of these options. So I just threw it over there. I'm going to keep an eye on it. Plus, it was saying it was a setup for a short. So I wanted to take a look at it. Does that make sense? As you make money from your put, you're also losing money on your call. How would you make money on this? How much? No, you're actually making money on both of them. So as the market, if you did this, let me see, let's go back to CVS. So for instance, if I were to buy this, let's close this one out, 75s, all right, so that's the one we did before. So if I'm going to sell this option and buy this option, you can see if the market goes down, if the market went from 75 to 60, if it went from 75 to 60, it lost $15, right? Just to give an example. The way to look at it is that means it kind of lost value by 15 ticks, so then we can look at the 90s to give us an idea as to where they're kind of, you know, ballparking it in a sense. You know, of course, there's going to be days of time decay and stuff like that added in, but you can see these went from $4 and let's say 70 cents to 44 cents, so we made money there. And these went from $3 and say 70 cents to what did I say, 90s, to $14. So that is an increase of $11 here and a decrease of $4 there, so we made $14 on a $14 plus on a $15 move. Does that make sense? Anybody else have any other questions? Real quick. If there's a shift in dividend policy by the underlying company, does that also cause any problem or complexity to the strategy? That is a great question. And yes, it will. You know, as options, you're going into dividend risk and stuff like that. It's going to kind of, the calls are usually a little bit more affected by dividends and stuff like that, but because you have both of them on, it should somewhat counteract each other. All right, so Chris and a lot of you guys have been checking this out. If you guys learned anything at all from this, I mean, this is a great deal for $7. I mean, you can't even get lunch for that. The other thing is, if you think you're better off playing probabilities, you definitely should sign up for this strategy. I always play the probabilities. That's what I look at. That's what I try and pound into my students' heads is it's probabilities. I mean, we all kind of look at charts and we're looking to try and read the tea leaves and stuff like that. And I do think that charts do help. But at the end of the day, when I finally am setting up a option strategy, I am looking at it as the probabilities. And, you know, a high probability scenario is the best. It's just like, you know, when you see these guys playing cards on TV and stuff like that, they're playing the probabilities on every single hand that they get because they're trying to increase their probabilities of success. If they don't think they have a high probability hand, they dump it. It doesn't matter what it is. If they think they have a high probability hand, then that's when they go in. And when they think they have a really high probability hand, they go all in, right? So I talk about probabilities all day long. I talk about probabilities. I teach how to figure out what the probabilities are of every strategy in these market commentaries. This particular strategy, I guess I didn't. It's 50-50. When you break down the numbers, if I look straight at it, you know, anytime you buy a stock, that's 50-50. Anytime you sell a stock, that's 50-50. That is straight up probabilities, okay? But other option strategies will have better probabilities, you know, but when you have better probabilities, you're going to give up something, you know. There's when you have less risk, you have less reward, right? So this is one of the higher risk strategies, but it has one of the highest, it has probably the highest reward. So the same thing with the synthetic long. So when you're buying stocks outright, that is probably the highest risk strategy you have. It's basically it's a coin toss, but it's the highest reward if you're correct. So keep that in mind. But I have other strategies out there that have higher probabilities. And, you know, it's more like when you're going out and buying stock and stuff like that, you're looking for a home run. And when you're playing with my different strategies, I'm looking for singles, doubles, and triples, you know. So keep that in mind. So higher probabilities equals higher success rate. And you guys need to be trading with this knowledge, because if you aren't trading with knowledge of probabilities and some of the other things like using the charts to increase those probabilities as well, you know, then you aren't doing yourself any favors. You're doing yourself a disservice in a sense. So in this course, all of these classes are designed to create more consistent results, all right? Let's produce consistent winners throughout. And for $7, this premium membership trial offer is, you know, it's you know, it could pay for itself in one trade easily. So take advantage of this. You also get the daily market commentaries, which I go through every single one of my trades. You know, the good, the bad, the ugly. I go through the trades that I'm winning on, and more importantly, I go through the trades that I'm losing in. And I talk about how I'm staying mechanical, how I'm managing that risk, what I'm doing to increase my probabilities with that particular underlying. I constantly go back and forth with that stuff and add different strategies around it, try and increase my success rate. So I hope that that is as beneficial to you as any of these other classes, because you don't learn anything from winners. You only learn really good mechanics from losers, and I go over all of those in the daily market commentaries. You also get all of my options trading workshops that are in archives. You also get, you'll get access to future live webinars like this one here, and for $7 you can't beat it. You also, like I mentioned, somebody was asking about mentorship. That comes with the mentorship. Reach out to me. If I can't answer your questions or help you out, and an email, in an email, if you're asking me what you should do, or what you should do, I should say. If you're asking me what you should do in a particular situation, I can only tell you what I would do. So you have to kind of take that information that way. I can only tell you what I would do. I can't tell you what you would do. But at the end of the day, I'll give you a really good answer as to what you're dealing with probabilities and things of that nature, and weigh those risks. And if I can't answer it in an email, like I seriously don't like writing books for emails, so I would reach out to you via a phone call. That made life a little bit easier as well. I have no problem with that. So you can reach out to us at 310-598-6677, or you can email us at protraderstrategies.com. The link to this is actually in the chat window. So we've been talking back and forth in the window that is the questions box. This link is right here in the chat window, so you can just click on that. It should give you straight to this page here, which gives you that 1 month for $7, which is great. And somebody else was talking about the Primo, or just asked about the Primo charting thing. You can also call us at 310-598-6677 and talk to them about that as well for future reference. But you get a lot of stuff with this. I also even have little shorter videos where they're like 10-15 minutes long, where it's kind of like a refresher. I also go all the way back and talk about I have some fun ones where I talk about the inspiration to options and where that came from. Believe it or not, it was before Aristotle. All right. Yes, phone call with GoToWebinar. Type mentoring doesn't really help. Yeah, I agree, Chris. Like, I'd much rather, believe me, I don't like typing. I'm terrible at typing. It drives me nuts. I'd rather do the phone call. So if that works best for you too, we can work something out. All right. Yeah, I talk about some of those other things with like RSI and stuff too. What was it? It appears that option pricing encompasses almost all the available information. It does. Looks like we can almost minimize all other parameters like momentum, RSI, and all of that. Yes, it does. And at the end of the day, even RSI and momentum, I have RSI on mine, I think, or I have actually the MACD, which is very similar. I actually have them on my charts, but to be quite honest, I don't really look at these that much. I'm usually looking at implied volatility on things, and the reason why is because that speaks, and I pull up a SPY chart, and that's not going to show me any very good at implied volatility. I guess SPY would, but I talk about even volatility crush and how to take advantage of these type of situations where volatility is really high and it crushes down. That's when you make your money, is when you can get volatility crush happening and get ahead of that, take advantage of that. That's the best in my eyes way to trade, taking advantage of volatility crush, which usually comes around earnings. And this class talks about all the earnings setups, the best strategies to use around earnings, and which ones I talk about, which ones not to use too, more importantly. You know, I saw a Goldman Sachs guy one time say, buy calls 5 days ahead of earnings and sell them after the earnings event. I'm like, that does not make any sense at all, because the volatility, you could be directionally right, and the volatility crush, all that premium coming out would totally decimate any profits you had, even if you were directionally right. So I think I shared the link in there. Can anybody else see the link in the chat window? I posted it in there maybe a little bit late, but if you go to the chat window, it's not actually in here, Chris. So I'll post it to you if I can't, if I do that right. I think I posted you a link, Chris. There is no chat window. All right, well, here, I'll do this. I'll try and see if I can do, what do I got to do here? Let's see if I can post this to everybody in here. I think everybody should have gotten, can anybody else see it? You don't see it either, Vicky? I'll post it to you too. Send to all, are you getting those? Oh, got it, all right. You see it? All right. Anybody else not seeing it in the chat window over there? It should be on the main. I popped mine out. You guys might have popped yours out also. It should be over there in the main control panel for go to. All right. Did you get that? I sent it to you, Randolph. It's on the side there. Might have to like try and copy and paste that. I don't know. No, it shows up a little differently to me. But yeah, for $7, you can't beat that, you guys. Really good deal. All right, hey guys. I want to thank you guys all for letting me drag out past my allotted time. But basically, later webinars, I'm going to be drilling down on different options components and when and where I find them appropriate. Also, reach out to us at trading@protraderstrategies.com right here. If you see a strategy that I haven't covered, you know, send us some ideas. I mean, I think I've pretty much covered almost all of them. Some of them I kind of stay away from because I think they're a little bit funky, like the guts and stuff like that. I don't really trade those, but so I kind of stay away from them. And on the floor, we used to hate those, so I just, now that I have the opportunity to stay away from it and I don't have to participate, I kind of stay away. And this is also the link, like if you're watching this on tape delay, you can just pause and write this all down to get to that link as well. And thank you for watching. You can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. Like I mentioned, if you're a premium member, you get unlimited access to me. And believe me, I will be on it with you. Thank you, Andrew. Appreciate it. All right, you guys. Everybody have a good weekend. Stay safe. Have fun. And if you can't take that, take it easy. Thank you, Mercy. Hope to see you around some more. Thank you, Chris. Take care. Thanks, Randolph. Appreciate the kind words. Thank you, guys. Appreciate it. Appreciate y'all. Have a great weekend.